I'm Jack Otter, Executive Editor.
And I'm Alison Rogers, MoneyWatch real estate blogger.
In today's reality check, we've received some bad news about the housing market this week. But what do those numbers really tell us? So, Allie, these numbers seem to be horrific. New home sales are at the worst level since they started counting in 1963. I think it was just over 300,000 homes sold. Mortgage applications, again, down in the depths, I think lowest since 1997. More people are underwater on their mortgages than ever in history. What's going on here?
Well, Jack, I'm actually a little bit more of a bull than most people, so I'd like to point out that a lot of those numbers aren't as tragic as they sound. New home sales, for instance, are at 300,000, which is down from 900,000 at the beginning of the decade. But that just means that new homes have become increasingly irrelevant. What we're seeing is that existing homes, which is sort of the big picture, all the houses that are sold number, is actually recovering from a year ago. So it's really, if you're investing in a home builder like Toll Brothers, new home sales number is a drag. But if you're looking at the overall real estate picture, it appears to be going along okay.
Well, if we have fewer subdivisions ripping up the landscape for a few years, I won't be crying. But I look at the outlook going forward and I see, okay, this homeowner tax credit, $8,000, that gets snatched away at the end of April. Plus, we know the Fed has been buying, what is it, 1.25 trillion worth of mortgage-backed securities, which has been keeping the level of mortgage rates down to, what, the lowest since the World War II ended.
The Fed has done a very good job of subsidizing mortgage rates, and people are kind of used to the drug of those 5% kind of numbers. That's really the risk for the housing market. You put your finger on it, is that once those rates start to climb, the difference between 5 and 6% is 20% difference in affordability. So we'll have to see what that does when it happens, but right now it's just a cloud on the horizon.
So if my monthly payment goes up 20%, I'm just simply not going to be able to pay as much for that new home, or old home for that matter.
Presumably, unless suddenly your job gets better and better, which doesn't look like it's happening in this economy.
And this is one of your key points. Instead of looking at Case-Shiller and all the other numbers, what's the best way to actually judge the housing market?
The best way to judge the housing market, especially because remember real estate is local, is to look at local employment numbers. When people have jobs, they buy housing, and when people have good jobs, they run up the price of housing.
So if we want to know what the future of the real estate market is, ignore all this, just look at the housing numbers, city by city, state by state, town by town, then we'll know when real estate prices are going to rise.
Take a look at what your housing numbers are doing in terms of aggregate existing home sales, and take a look at what your employment numbers are doing in terms of jobs. Those are your two key numbers to watch.
And that's your reality check. Thanks for watching.